Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London coffee markets. New York coffee. The pipe tops formed on the 9th and 12th of September last year were the direct triggers for the move lower that we've seen until January this year. The actual pattern was set up for the move lower, the lopsided diamond pattern that's seen disappearing onto the top left of my daily chart and highlighted dark blue is huge. I'd previously given a primary target for this in the 166 and 3/4 area with a secondary harder to achieve target X1 in the 142.40 area. The primary target was achieved in early November and the harder to reach secondary target X1. Well, we came awfully close in early January, but the congestion around the 2019 high at 142.45 and the September 2017 high at 143.35 proved to be too much for this attempt lower. And we dodged it, but only just. I'm still calling it live for now. I said at the time when indicating these targets many months ago now, and I quote, "There is one other fly in the ointment, perhaps, just perhaps, the lopsided diamond pattern is becoming a big bear channel. If that was to be the case, then the first area to look at below would be the lower bear channel line of such a pattern. And that's currently 147.40, end of quote. The extension of this bear channel is highlighted in bright green on my daily chart, and the lower bear channel line has played a significant part in recent actions. Since January, prices had halted their rise at the nearby 50% Fibonacci line of the May 2019 to February 22 move at 174 even, which I've highlighted in purple on my daily chart, using it as a support for an attempt higher at the upper bear channel line. And that's currently at 196.10. However, this upper bear channel line is not alone, as since last summer it's had the added reinforcement of the declining long moving average, currently at 195.5. This capped the market 2 weeks ago. We've seen a move down to the 50% Fibonacci line, the purple Fibonacci line below once again, though as we have come closer, so have prices started to react back upwards a bit. On the overall action, well, I spoke about this in early December 2022, that perhaps all this drop and sideways action, even the pullback up, may be turning the market into a descending scallop pattern, especially after looking at London coffee, where this seemed a more reasonable idea. Well, part of me still holds to this idea, which may surprise you, but I'll explain why shortly. Though the fall since the start of this year was in line with a bearish move into the descending scallop pattern, including my laying out the primary target X in the 128.5 zone and the secondary harder to reach target, a much harder to reach target X2, way down in the 78.5 zone, and off the bottom my daily chart incidentally. Despite laying these targets out, I still hold to the idea of a possible descending scallop pattern, as this pattern, as I said a few weeks ago, and I quote, can also have an upward breakout. But, and it is an important but it will depend on what the market does should it get to the key 50% Fibonacci line of May 2019 to February 2022 move at 174 even. For the moment, I'll leave the targets where they are below, but they could easily be retired on confirmed moves higher over this 50% Fibonacci line. End of quote. I am ready to retire the downside targets here, but I still wish to see just what the market will do as it approaches the 174 even area. In coffee. The lower time, currently 16.45, the late December 2021 to mid-July 2022 bearish Andrews pitchfork, which I've conveniently highlighted in dark blue on my daily chart, was where the current rally started back in mid-November last year. We've seen the market since then curl upwards, show some indecision, especially over the 2018 high at 18.45 and under congestion at 18.97, until in the second week of January saw a weekly key reversal up that punched up through the congestion at 18.97. Thus we come to my commentary from 11 weeks ago, when I put forward a new suggestion at the time on what may be happening. See, looking at here at London, especially a little also at the New York contract, I suspected at the time that the action since mid-October may be becoming a descending scallop pattern, sometimes called a backwards letter J pattern. Here on the London contract, and especially on the London contract, this pattern had merit. So here are just the primary targets, both above. Prices seem to be willing to go that way. Okay, so a primary target X was in the 2095 area with a harder, much harder to reach potential topside target X1 in the 2280 area, where the 2017 high is. Target X was reached 3 Fridays ago and even exceeded somewhat. Prices peaked 2 weeks ago over the upper time, currently at 2133, as well as the August and June 2017 highs at 2173 and 2175 respectively. They did not manage to hold up there, though last week there was another, if slightly lesser, attempt higher. Question now is whether this move above the upper time 2 weeks ago and again last week, whether this was a break higher or still just a breach higher. To me, it seems the overall movement is still higher, and that is why target X1 at 2280 is still live as I speak.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.